We don't have a lot of speed. Good morning, everyone. Just a question, can you see my full screen, Rajneesh, or is it not yet in presenting mode?
Good morning, Roger. Yes, we can see the screen, but it's not in the presentation mode, I guess. I think we can see your find and replace and the footnotes as well.
Yeah. Just trying to find the way why I think this is the button, but resume slideshow. It's this.
Still, we can see the notes, not the presentation mode.
Yeah, at the moment I don't manage to get to the right place.
We are waiting for friends and colleagues from RRA to join us in the meantime.
It doesn't work. Want to reason.
Your technical team, maybe Katwanu and others may. Yeah.
Keep trying to see what's happening. Okay, maybe it doesn't work, but we can just do it like that. It doesn't really influence. It's not the best way. Or Kutlano, you can share your screen. Is that possible?
Yeah, perfect. Any chance Roger, our colleagues from RRA has joined us?
I think they're still checking.
Sorry about that, everybody. We are just waiting for colleagues from Rwandan Revenue Authority to join us. We understand there is some technical issues their side.
Okay, Winnie is there as well, so I think.
Lovely.
Kutlano, you managed to share the slides on the screen?
Yes, I think, yeah.
Okay, so I will start right now. So welcome everyone to our webinar. All you need to know about the latest developments in transfer pricing and corporate income tax in Rwanda. So I'm here as Roger. I'm the CEO of Visions Africa. We are an accounting firm based here in Rwanda, and we serve mainly Rwanda, other African markets, and Europe. And I'm joined today by Rajneesh who is a partner of us that we have done already many transfer pricing engagements. And he is joining us as the expert on transfer pricing internationally. So I'm looking forward as well to be joined by Winnie from RRA. And it's really great that we have this opportunity in Rwanda to have like very open conversation about transfer pricing, both from the practitioner side, but also from the revenue authority side. So about our companies, we are basically, our firm is an accounting firm. And then Rajnish joins us from Regan van Roy, which is specialized in transfer pricing. And they have a team which is widely dispersed in different jurisdictions, and they bring like a wealth of experience for transfer pricing across the globe. And
please.
Winnie is joining us from RRA. She has been working there at RRA for many years, and she is also part of the transfer pricing team, which is a growing team at the Rwanda Revenue Authority. For the agenda today, we have first the introduction. We're going to tell in very practical steps what is actually transfer pricing, what are the global trends. We will, of course, talk about Rwanda's transfer pricing situation. Where do we stand now? What is actually required from the companies? And then we try to do a lot of practical questions and answers where we have interaction between me, Rajnish, and RRA. And we will, of course, as well tell you what you should be doing in order to be compliant and to avoid any issues with the Rwanda Revenue Authority. And at the end, we open up questions for the whole community here so that we can also answer some of the pressing questions. I would like to hand over to Rajnish now for what is transfer pricing. Can you tell us a little bit more about that?
Thank you, Roger. Thank you, everybody. It's wonderful to be part of this presentation along with Rwanda Revenue Authority. So very brief, without getting into much details, for taxpayers, transfer pricing is nothing but pricing between intercompany. It could be related to sales of goods, it could be related to provision of services, it could be related to intercompany financing. Any transaction between related companies comes under the perspective of transfer pricing. Primarily transfer pricing, there is always from tax authority side that there could be a motivation for taxpayers to shift profit or loss in the jurisdiction they want in order to pay more favorable tax in their perspective. So that's why it's one of the top focus of the tax authorities across the world, transfer pricing, that they should be charged at arm's length. That means they should be charged at market rate. So any intercompany transaction between related companies, either services or sales of good or intercompany loan, should be done in a similar way what third party would have done. The pricing should be similar to what market would expect, so that they pay their fair share of tax in respective countries where they're operating. So primarily the tax authorities are interested whether the local entities are paying the fair share of tax based on the functions performed, based on the services provided, based on the assets employed, and the risk they assume while performing services. Now, the basis of transfer pricing, the international tax landscape is changing fast. There's a paradigm shift in global taxation. Business and its supply chains have evolved substantially in recent years, and it puts a strain on international tax rules, which were designed more than a century ago. Weaknesses in current tax rules create opportunities for base and erosion and profit shifting. That requires bold move by tax authorities to restore confidence and to ensure profits are taxed where economic activities take place and where actual value is created. This led to the implementation of OECD BEPS project, which represents a fundamental change in taxation. The current taxation system, or we say the previous taxation system, was based on a legalistic approach. where tax minimization was considered a general acceptable principle. BEPS has been shifting the nature of taxation from legalistic approach to align it with value creation and economic substance. Now, when we say all these big words like value creation, economic substance, what does it mean? In simpler, it means it links value creation with where the employees are, where the actual assets are, and where the sales are being performed. Now, the loss of global tax revenue from shifting of profit, it is estimated by OECD that it could be around US $100 billion to $240 billion. So anywhere between 4 to 10% of global CIT revenues, global corporate income tax revenues, as per OECD estimate. So that's why OECD is working with respective tax authorities in many countries to change domestic tax rules, to harmonize tax laws so that the practice of shifting profit can be stopped. And harmonizing domestic tax rules across country is easier said than done. Each country has different economic priorities. They compete for investment from multinational enterprise by providing different tax options, as you all know, and based on economic priorities. So what OECD has already put in place is various tools and is working with several tax authorities, including RRA, across the world to implement BEPS approach. This approach primarily represents that there's a renovation of international tax rule in more than a century. The implementation of BEX project, actually we call BEX, is nothing but it's allowing that whether taxpayers are paying their fair share of tax based on the function performed by them, based on the assets employed by them, and the risk assumed by them. And obviously, with this background, you can understand TP is the transfer pricing is the cornerstone of international tax. The TP models are being checked whether there is a form versus substance issue. We have a business form that the company is performing certain functions, say limited distributor, or say it's as a service provider. But is it actually a limited distributor or is it a full-fledged distributor? Is it a sales agent? Is it an actual service provider or is it a contract service provider? So models are being challenged, models are being questioned based on actual business form versus substance. So there's a tug of war between tax authorities in each jurisdiction to get their fair share of tax. They want to ensure that local local entities are paying their fair share of tax based on the function performed. And they want the profit should follow the value creation as per the BEPS project. Next slide, please. So the internet, what is the arm's length principle? You'll often hear the arm's length principle. So without going into the definition, which is already in the slide, in simpler words, it's what third party would have charged. If I and Roger are friends, maybe we'll say, hey, you charge less on this, and maybe we should have profit in a certain country where it's tax favorable. But when we are dealing with third parties, we never do that. We always transact at market rates. So tax authority expects the related companies to charge at market. So either you devise a pricing policy based on rate comparables from third party or through benchmarking, but it should be similar to what third party would have charged. So that's basically arm's length principle in simpler terms for layman's perspective. Next slide, please. So in transfer pricing, the onus is on taxpayers to prove that the intercompany transactions or the transaction with associated enterprise are at arm's length. How do you do that? You need evidence in form of various documentations, financial data, legal agreement, and obviously documenting what are the functions, assets, and risk performed by local entities versus related companies. Please remember, transfer pricing is never a one-sided function analysis. It's a two-sided. How both entities, what they are doing on the either side of the transaction, who is contributing how much, and based on that, we do a functional characterization, and based on that is compared with third-party rates and see whether they are at arm's length or not. So in putting simply, it's people function, the ability to control, who is managing associated risk, the focus of risk. This word, initially we were only focusing on function, but BEPS has changed the nature of function analysis by focusing on risk. The higher the risk an entity in the related company takes, the higher the return, as we all know. So that's why now the risk is also a major part of BEPS initiative. We need to understand various categories of risk assumed by each related companies, and based on that, value is created, and based on that, announcing price is determined. So to put simply, overall, who does what? Either side of the transaction, a related company versus the local entity. What is the economic significance? Who is performing what function, and how much is risk in the value chain assumed by either entities? And then based on that, how much either side of the entity is getting paid. As I said, transfer pricing is not one-sided, it's two-sided analysis, and taxpayer on either side wants the fair share of tax. So if we are consistent with that, there's less chance of double taxation, there's less chance of controversies. If we are very clear on who is performing what and how they are being paid, there's less chance of getting into the controversies. Primarily, as we all say, the TP transfer pricing overall globally is governed by OECD, Organization of Economic Cooperation and Development transfer pricing guidelines. Most and almost all tax authorities follow OECD TP guidelines, and even Rwandan tax authority, for further interpretation, always refers to OECD TP guidelines. So in short, it's aligned. The Rwandan TP rules are aligned with OECD TP guidelines, as any global countries are. Next slide, please. So again, TP is external forces, internal forces. It looks dramatic, right? But it's what is happening. So outside Rwanda and inside Rwanda. Outside Rwanda, there is spate of new legislation aligned with OECD TP guidelines, as I said. There is upskilling of tax authorities happening. As I said, BEPS, through BEPS, OECD, and various organizations are helping tax authorities to upskill and to address those challenges of shifting of profit. Even in Africa, we have ATAF, African Tax Administration Forum, which is helping all tax authorities, including Rwanda revenue authorities, by various meetings, presentations, trainings, upskillings, OECD. Then there are discussions between tax authorities. They are meeting each other. They are learning best practices. They are sharing data among. There's a lot of information sharing happening. Even in Rwanda, there are certain ministerial orders and all which talks about sharing of information. So this helps. What is sharing of information? You cannot live in the word called cocoon. The tax authorities would know. They are sharing information more than you understand, more than we understand, more than we expect. They're talking to each other. They're understanding both sides of the equations. They're sharing information as per legalistic laws, and they're also getting updated. So what it leads, it says that if your business form versus substance is an issue, if your documentation is not correct, it could lead to more TP transfer pricing disputes, and more reallocation of sources. Your budgets would move, and trust me, there's a very keen political interest. It is considered as one of the largest revenue generating machine in tax overall. So those are the external forces. What are the internal forces? Obviously, there's an increased compliance obligations. It seems to be a burden for business. Business needs to rethink how we do business to ensure that we align with global best practices, alignment of business model versus TP model, documentation just not as more compliance as your core narrative of tax authorities. It's actually what you're doing rather than sharing a narrative. And then obviously the data should back what we are saying. So reconciliation of data and fact patterns should match. Most importantly, it's implementing and monitoring your business model. So in simpler terms, we would say your business model and TP model, the form versus substance should speak to each other. There shouldn't be any gap, otherwise it leads to controversy. Next slide, please. So who cares about TP? Interesting, isn't it? Tax authorities and global regulatory bodies, obviously, RRA is actively auditing. And as I said, because of the sharing of information, because of those trainings, because of those discussions, because of various forums where they interact with global bodies, they are able to have a more focused increased auditing rather than generic auditing. And that transfer pricing is internationally a very huge key revenue driver, as I mentioned, not only in Rwanda, it's across the world. So it's also very important for taxpayers because any business with an international presence you are under transfer pricing. Your stakeholders, investors, and boards are increasingly focused on tax risk management, requiring transparency and robust compliance framework. Like reputation. I mean, it's like if you see globally, the famous Apple case, the famous, there are many cases in transfer pricing, which is across the world in newspapers, and it's a big reputational issue if it is seen by normal people that you are actually shifting profit and not paying your fair share of tax. So we need to be careful about it. We need to worry about it. So it's the public, it's the taxpayer, it's the stakeholder, and obviously tax authorities and global regulatory bodies. Everybody care about transfer pricing. So in short, it's just not a compliance and risk management. It's more about your business model optimization opportunities. We always say that, what is a business form? You optimize it by managing, by putting substance where your business form is, by having adequate documentation, by ensuring that your financials are matching, your pricings are at arm's length at market. It's what we call as bells and braces framework. Wherever, whatever form it is lacking substance, you add substance. You see the pricing. If it is not as per market, you make it as per market rate, and you overall optimize the whole business. So it's no more a compliance. It's more of it's how you run your business. Next slide, please. Often the question comes out, what intergroup transaction, Rajnish, are you talking about? So as I said, anything between intercompany, it could be intercompany service providing, like, we see a lot of head office services, what we call as management services. We see software development services, IT consulting services, a construction service, any kind of engineering services you're providing, or any kind of buy and sale, purchase and sale of goods. It also involves any kind of intangibles you're dealing with, whether it's a brand, whether it's an IP, whether it's a trademark, whether you're paying royalty, then any kind of intercompany financial transaction or intercompany loan, debt financing, any kind of financing, those comes under transfer pricing, especially interest-free loans are one of the top. Always looked into it. What is the interest deductibility? These are top transfer pricing issues. What is the low-hanging fruit for tax authorities? If I am a tax authority, they're all of them. What are the low-hanging fruits? And it's very important taxpayers knows about it so that they focus, that they improve these things. It's substance over form. Where the people are actually sitting versus where we are showing profit. Is it matching? Are you a continuous perpetual loss-making entities? You're consistently making loss, or you have significant profit fluctuation. Now, please remember, tax authorities cannot focus on everybody. There are few key things where you want to avoid. Tax authorities look at, okay, is there a significant profit fluctuation? What's going wrong? Is it because of related party transaction? Are you doing something which is not as per market? Procurement hubs, back-to-back transactions, any very high value transactions, royalties, loans, goods, this always comes under, tax authorities want to have it. These are low hanging fruit for tax authorities. Again, core business is related party. If your core business is related party, majority percentage of your revenue is from related party, that is also looked at by tax authority. And any kind of restructuring, any kind of shifting of intangibles or mergers and acquisitions or changing business models, those are also low hanging fruit for tax authority. Authorities want to ensure that you are compliant with market rate. You are doing everything as you should be doing as per the TP rules implemented locally. Next slide, please. So to complete the overall, I gave you a perspective of what international, what external forces are, what internal forces are, how globally tax authorities are talking to each other, how they are performing focused transfer pricing audit, what exactly they are looking for in a related party transactions, whether your business form is meeting the substance, whether you have people functions in the locations where you're actually earning profit, they're actually following where the money is going and seeing whether the people functions are there. So what is the whole life cycle of transfer pricing? So if you see the presentation slide, always the compliance is about transfer pricing documentations and benchmark. Now, transfer pricing documentation and benchmark is compliance, but I often say if you are going into compliance and you are trying to set a narrative rather than planning, always you end up on the right-hand side, where is the dispute resolution. You're always under some kind of dispute. You're trying to catch up with the tax authorities. So we always say on the left-hand side, whenever there's an intercompany transaction, it's never late. Please perform some kind of transfer pricing health check. It's not always intentional that you might have, there could be no arm's length pricing in an intercompany transaction. So it's always good to do a health check and understand very briefly where the risk lies. Are the business form matching the substance? Are your related party transactions at arm's length of market? Is there any issue with the whole legalistic approach we had? Whether the legalistic approach is meeting the people function? So you do a small health check and then you do a policy design. All related parties should be at arm's length, either through a benchmark, through other comparative analysis or economic analysis. And once you have a TP planning, you can easily convert the planning into a local file because you have done as what tax authority expects, as RRA expects, that your intercompany pricing is as per the arm's length standard, or your business form is meeting the substance. Once you did that, documentation and benchmarks become a routine. It's a very routine function. It's less risky. When everything is in order, you have very less chance of dispute. You have less chance of controversy. So you don't need dispute resolution and controversy management. But if you are catching up always and just treating transfer pricing as compliance issue, it's always chance. I'm afraid the chance is to go on the right hand side. So what I say is that do your health check, do your planning and design policy, and then implement and monitor. That is the operational TP. Once you know that, okay, you have to charge a cost plus X% for a service or an operating margin for a certain kind of buy and sell, you know your pricing policy, then you continuously, monthly, quarterly implement and monitor so that you don't fall off the track. Then transfer pricing becomes a routine. Your business form meets a substance, and there's less tax. Everybody's happy, and even RRA or any tax authority, when they see the documentation is evident, you have enough substance, everything is fine. Less chance of they pick audit from there. They will always look at the low-hanging fruits or where there are issues with the taxpayer. So that's an all transfer pricing life cycle and the external and internal forces of transfer pricing. Give it back to you, Roger.
Yeah, thank you, Rajneesh. I think as we have now a short introduction, we are moving more towards the requirements of Rwanda. And as you have heard before, I read somewhere that in Rwanda, I don't know how they calculated it, but apparently 30% of RRA's revenue is from TP audits at the moment. So this is a massive revenue machine for Rwanda Revenue Authority. And therefore, it means that maybe companies are not as prepared as they should be. So they are coming more in the dispute section that was described before. And when we look at documentation and the requirements, then sometimes it's actually quite simple. Yeah, if we can go to the next slide. On the next slide, basically, I'm not going into these details, but if you have an arm's length principle, it means that you cannot give interest-free loans. That just doesn't exist. Nobody would give you money for free on the market, unfortunately. So you also need to make sure that you are basically charging adequate interest rates. Yeah. The same applies for when we see companies having payroll somewhere in a tax haven, but they're working maybe in Rwanda, but some consulting payroll is appearing somewhere else. These things simply don't work, and this is where RRA carefully looks at the details. They will do the interviews, they will screen the company, and I can guarantee you they will find it out. Yeah, so it's better to be prepared for this. Next slide. Here we basically see the recent transfer pricing developments in Rwanda, and I'm just running very briefly through it directly. So I came to Rwanda officially in 2018, and at that time, certain laws have been implemented, and it was kind of like a first move that transfer pricing documentation should be established. There was not yet too much guidance, but of course you have the OECD guidance, and we followed this approach. Yeah, but it was not really too serious, I would say. But RRA has started to work on it, and We then have had the developments on the laws, on the ministerial orders in 2020, which was very crucial. And then in 2023, a further enforcement with the tax procedures law, which also clarified some of the details. And then now what we are seeing is really, I mean, it has already started, and that's why RRA has these big revenues from the TP audits. It really starts to be enforced. RRA has a proper department, they have the skilled staff, and they have also experts that still support them on these kind of TP audits. So today, I would say, if you qualify for the requirement that you have to have transfer pricing documentation, you should really make sure that you're actually complying and that you are ready for whenever RRA knocks on your door. Can we have next slide? Yeah, so I think, Rajnish, can you briefly describe the transfer pricing landscape that we have here? And basically, it's like similar basically in every country. So when we talk about Rwanda, the same basically applies in the other jurisdictions as well where you operate.
Thank you, Roger. So in practice, Rwanda has moved towards a more formalized and rule-based approach with increasing expectation around documentation and compliance. Now, the question is, what are the key transfer pricing compliance requirements in Rwanda? So to make it simpler, what I would say is what, who, and when. What are the compliance requirement? Who should be who is falling under the perspective, and when and how they need to apply what they need to do. So primarily, we'll go into the details from next slides. It's just a brief overview here. So maybe next slide, please. So what TP documentation required in Rwanda? Primarily, there is a disclosure form. We call it as TP annexure. It generally requires general tax-based information. It details of the related party transactions. It wants you to fill what is the nature and value and threshold of transactions. If there are any exemptions granted, these are briefly, it's very detailed, but you can fill it in. It's pretty simple format. It's what helps tax authority understand what related party transactions you are having in the particular fiscal year. If you're disclosing your related party transactions, then tax authorities, Rwandan RRA expects you to have a local transfer pricing documentation, or what we call as a local file. The local file generally gives an overview of the local entity's business operation. It talks about the details of domestic and cross-border related party transaction. Please remember, Rwanda also looks at domestic RPTs or related party transactions beside cross-border. Then the function analysis, how is the management, who are they reporting to, what are the local organization structure, what is the group structure, where Rwanda falls in terms of the group overall subsidiary versus parent. As I said, local organization structure, like who is reporting to whom, how many peoples are there, to understand the people function. And then we have controlled transactions and uncontrolled. We discuss about covered transactions for the particular year. And then based on the related party transactions for those years, the selection and application of TP method, and if required, an economic analysis like benchmarking or a CUP or a comparability analysis. And then you conclude based on the third party rates we get from benchmarking analysis or any other TP methods like CUP and others, you decide whether the pricing between related companies or intercompany transactions are actually at market or similar to what third party would have charged. Then you comply with the arm's length principle. So ideally, local file is more for testing purposes of a related party transaction. The report is actually testing whether your related party transactions falls within arm's length principle or not. If it doesn't fall, there could be a potential adjustment, there could be potential penalties. So it's always important for taxpayers to understand the basics that, your transaction needs to be arm's length, and this is the documentation and evidencing of that your transactions were conducted as expected by RRA. Then there's a master file. Master file is for the group parent, so you also need to prepare, if you cross certain thresholds. It gives overview of global business operation of the group as a whole. It gives the group intangible and financial activities. It gives the whole organization and ownership details in much bigger and from the parent side, the comparison between uncontrolled transactions, and it also talks about overall global business operations of the group, the financial activities, the financial and tax positions, and the organizational ownership details. So this master file is a tool. It's a document which helps tax authority understand the group as a whole, and it is aligned. The RRA master file requirement is aligned with what OECD TP guideline talks about. So the master file, the local file, there's a TP disclosure form, and obviously CBCR. If your international parent needs to file CBCR, that also needs to be shared between tax authorities. So overall, the TP documentation requirement is 3-stage as in OECD, local file, master file, and CBCR, and additionally a TP disclosure form when you file the CIT returns to give a glimpse of what are the international related party transaction you have during the financial year. Next slide, please. So what Rwanda TP compliance obligations are? 3 steps primarily. RRA keeps saying it amply in all the tax manuals and the website, apply the arm's length principle. That means pricing must reflect market condition. You have to submit a control transaction schedule, which is a TP annex. It is filed with CIT returns annually. And then you have to maintain contemporaneous TP documentation. Contemporaneous word means year on year. You can't miss a single year. So this must be available as per the tax authorities, as per the law, you should be filing along with CIT return. Till now, it was not filed. RRA has allowed it. So the taxpayers, quickly get updated. They have given the time. Right now, the RRA has given 7 days of a written request. You can submit it. But as per the law, you're supposed to file the TP documentation along with your CIT returns and your TP annexure both. Next slide, please.
Thank you. I think we can now speak directly with RRA, with Winnie, but you have definitely seen from the last slide that if RRA starts to request from you documentation, 7 days will be really impossible to prepare everything. And even if you're able to prepare some documentation, then maybe your structure is not aligned with what you have on your documentation. So in any case, it's going to be very tricky for you to go through an audit. But if we can have Winnie, maybe you can tell us, how does basically Rwanda Revenue Authority approach transfer pricing reviews? Could you tell us a little bit more about this?
Thank you, Roger. Here is what RRA expects from as a TP documentation. First, we need to look at you need to have clear functional analysis where you show where we need the accurate delineation of functions, assets, and risks. Like here, we are trying to say who does what, who uses what, and who bears which risk. And you need to align the contracts and the actual conduct. We find that contracts are mainly there, but what is done on the ground is totally different from what the contract says. So you need to align for an intra-group transaction to be allowed. The contract is not enough. Yes, you need to have a contract, but the contract has to align with the actual conduct of the transaction. Then we need the economic substance, evidence of the real decision-making capacity. Do you have the real staff to make these decisions? Can you evidence it with the minutes of the meetings that are held? Can you have the reports of the work that was done? So basically here we are saying, apart from having it there, we need to see the actual, or maybe the economic substance, or maybe what the company benefited from this. Did you request for this as a company? Did it improve on your revenues? Did it reduce on the costs? Did it improve on the efficiencies? So we need those. You need to support that with the minutes, the reports, everything around the requests, whether the company requested for this, and the economic substance that it provided for the company. We need all these. We also, as I said, the availability of supporting evidence. we said you need to have the agreements. Are there agreements to support that this was done? Do you have invoices? Can you show like the benchmarking studies? You need to benchmark and do the actual benchmark. So as RRA, we don't rely only on the contracts and evidences and agreements, but we also need to see the actual benefit, or maybe what the company benefited from this. So I think that's what I can say about that. Thank you.
Yeah, thank you so much, Winnie. And yeah, I just want to repeat what Winnie said in terms of the alignment between contracts and actual conduct. So when RRA does an audit, they typically don't only sit at their desks and study the contracts and supporting documents that you have provided, but they will actually come into the company and conduct interviews and walkthroughs through the procedures. And then it will often quickly reveal if the contracts are aligned with what actually happens on the ground. Yeah. So if you have staff in your company here in Rwanda, which might not appear on payroll, or you have maybe some services that you get from outside, and if it's IT support, accounting support, or whatever else you can imagine, then RA will briefly check with their questions, and they can easily find out if something doesn't align to the ground. And Rajnish, maybe back to you. So how can now these companies understand the current level of transfer pricing enforcement in Rwanda? And basically, who is now subject to the TP rules? Who needs to be ready for this kind of documentation and preparation?
Roger, sure. So the question is from what, who, and when. You remember, so to make it simpler for taxpayers to understand who is subject to the rules. As I said initially, any company, whether you're part of a multinational enterprise or you have international subsidiaries or related companies, and if you have any related party transactions with them, you form part of it. So primarily to give examples, company could be involved in goods and distribution transaction, manufacturing, sale. It could be service transaction, it could be a management service, it could be technical arrangements, it could be software development services, it could be any kind of services between intergroup. It can be financing and intercompany loans. Often group companies tends to provide support group companies among themselves, whether the interest, whether they are charging an interest, an arm's length interest or interest-free loans, that is under perspective. If there is an IP which is utilized by group companies, with what is the IP licensing and the royalties, whether they are at market and arm's length. And in Rwanda, we also have a cap on IP, so we'll discuss that in detail. So these are the companies who are actually, so any related party transactions, if you are part of it, and if you are crossing certain thresholds, or whether you're not crossing thresholds, you have to be at arm's length. Now the question comes threshold. Do everybody need to prepare TP documentation? Often it is seen as a burden, right? It's a cost incurred. It's a lot of resources. Many companies who are startups, who are small, medium sized, should they incur the cost preparing through the robust TP documentation? Understanding that, and from the global trends, RRA has said that, okay, there are certain thresholds. If your turnover exceeds more than FRW 600 million, if your control transaction exceeds 10 million, or your aggregate control transaction exceeds 100 million. So in short, transaction wise, any related party transaction, each transaction, if they exceed 10 million Rwandan francs, or an aggregate all related party transaction, if it considers 100 million, or your turnover exceeds 600 million, you have to prepare TP documentation if you have a related party transaction. Now, that doesn't mean the small taxpayers are not, they don't need to prepare robust TP documentation, but RRA still expects them to have their related party transactions at arm's length principle. RRA may choose to question if they want that whether they are meeting the arm's length or not, but they don't need to prepare the TP documentation. They are saved from the burden of preparing the cost of preparing TP doc. But to be honest, Roger, the turnover, the thresholds are quite minimal in terms of global revenue, if you see. So the compliance is quite low. So it's essentially any multinational group or any large company which has significant or maybe decent related party transaction will fall under the trap. What is important note is that entities exempt under the thresholds of relief and standalone entities with RPT, as I said earlier, must still comply with the arm's length principle, even if they are not required to prepare TP documentation. Next slide, please.
Yeah. So Roger, is really the threshold is very low, and I also I struggle to understand when a small startup, which often has these thresholds crossed, how they can prepare the TP documentation. But at the moment, this is defined by the law, and we have to adhere to it if we don't want to get into trouble. But of course, I would also say these smaller entities are probably less exposed than the big ones. Like if we're looking at the multinationals that we know very well as the brands, they're definitely more exposed than the smaller ones. Yeah. So RRA wants to grab the big fish, but definitely once they're done with those companies, it will trickle down, and they have already gained a lot of good experience with their TP audits, and they will be ready to then go at the broader mass of companies in Rwanda. Next slide, please.
Roger, just briefly, even for small taxpayer, all the RRA expects is to be at arm's length. If you have less revenue and we understand that you may not have your startup, you can always reach out to us. We can help you with a minimum to make sure that at least your related party transactions are at arm's length. We can help you with that for a very small fee, understanding you're a startup or a small company. It depends. We don't need to do the robust TP documentation if you're not crossing those thresholds, but we can still help you with this arm's length, because all RRA expect is that your related party transaction is at market. So if that is done and your calculations are matching, I think you'll be fine.
Yeah, that's true. And great offering. Yeah. I think, can we go to the next slide? Thank you. I would like to ask Winnie again if you can present the example that you have prepared. What happens when we have now an RRA audit and you have a TP adjustment case?
Thank you, Rogers. Here is an example of a TP adjustment. Here we have a scenario where a Rwanda-based company distributes goods for its foreign company, for its foreign parent, sorry. So during audits, these are like the findings, what we saw. The revenue reported, the company reported a revenue of 6 billion with a profit of 120 million. That is a 2% margin. But from their financials, they had high management fees and intra-group charges paid to the parent company. There are no sufficient transfer pricing documentation, and the industry comparable show 10% margin. You can see this 10% higher than the 2% that the taxpayer declared. Then go to the next slide and see how the adjustment was done. What does RRA do in such a scenario? The arm's length profit should be 10% as per the industry margin. And 10% of the turnover, the 6 billion they had is 600 million. Then we do 600 million compared to 120. That is a difference of 480. That is an adjustment, or maybe revenues not declared. Now the revised tax impact would be 28% of that adjustment, of the difference between 600 million and 120. That is 28% of 480, which is 134,400. The penalties for understatement will be 20% of that principal, 20% of 134,400. The interest was estimated 12 months, which would be 24,192. The total tax exposure will be the principal tax plus the 20% of understatement plus the penalty the interest of 12 months. Remember, it can even go beyond 12 months. This is an estimate. So you can see how a small or maybe something not catered for can bring a big tax exposure. Sometimes, most of the times, figures go beyond this. This is just like an illustration to show how the impact it has for not documenting, for not doing a proper benchmarking. So, and this, another thing, apart from this TP adjustment on CIT, we always charge 15%. Remember, if it was a payment to a parent that is not here, remember you have to cater for 15% and VAT reverse charge when applicable.
Yeah, thank you so much, Winnie, for this example. And like Winnie said, this is now like an example which is for the goods, but also, of course, if you have imported services that you have not accounted for in Rwanda, there would be the other taxes, withholding tax, non-deductible reverse VAT, and yeah, like there is really a big mass of penalties that come to you, and it's really not convenient. And of course, if this was, for example, now an audit, I don't know, for 2022, then RRA knows exactly they can come back again and again and again, and you will probably have these issues again if you're not then revising and trying to rectify the situation for the newer years in your financials. Next slide, please. Yeah, so I just want a quick explanation for basically what is a related and party and connected person. Can you maybe give me like an idea about this?
Okay, Roger. So it's pretty much in the, if you see the Income Tax Act by Ministerial Order of 2020 on transfer pricing, the related party are defined as those who act or are likely to act in accordance with the directives, opinions, or intentions of another person. So obviously, we don't want to discuss what is written already in the law, but for simpler taxpayers' perspective, who it covers essentially is entities under common ownership or control. Or if you are acting in concert or influence of another. So you are reporting to somebody, it's your related companies, you are under influence. If you are related, it is considered you are under influence or other parties under influence, either ways. So in those cases, as we said, arm's length principle for all related party transactions, and that's the basis of TPP compliance. There's also an associated enterprise definition defined in Article 3 of the Income Tax Law, which is similar to what related party is. It's essentially if you have any related companies, you are under those associated law. So it is possible for a person to be both a related party and a connected person in case both the TP rules and deduction test apply. Back to you, Roger.
Yeah, next slide. And I think we come to the last step of these 3 points. If I can ask you again to continue here.
Yes, so the question is when and why. The timing, the TP documentation, as we briefly initially spoke about, it must be prepared contemporaneously. That means year on year, every year continuously before income tax declaration deadline. But that doesn't mean every year you do benchmarks, every year no. As per the OECD TP guidelines and RRA, which is aligned with OECD TP guidelines, if the nature of transaction hasn't changed significantly, if the function asset and risk are almost similar, you initially perform a benchmarking analysis, and then next 2 years, you can perform a roll forward of the financials of accepted companies. So essentially, first year you do a robust benchmarking exercise, and next 2 years you do a roll forward, which reduces your cost. This is to help reduce your burden. But after 3 years, again, you have to redo the whole function asset and risk analysis and perform a fresh benchmarking analysis. Please remember, the roll forward can only be done if the function hasn't changed, asset and risk hasn't changed. Then second thing, the timing is, it must be prepared on or before the CIT returns. And there is a filing requirement, which actually RRA has been lenient on that. But, as per the law, you have to file TP documentation along with the CIT returns and TP annexure form. Control transaction schedule is already there. What happens if you don't comply? There is TP adjustment. RRA may adjust taxable income to reflect arm's length pricing. If they feel that it is not arm's length, And if it is not arm's length, non-compliance can trigger tax adjustments. There could be interest, there could be penalties, as just Vinny explained earlier. There's an audit risk. If your documentation, if there's a lack of documentation, it likelihood of audit delays and disputes, and you have a reputational impact also. So both domestic and cross-border transactions are under the preview. There's no automatic corresponding adjustment. Often what happens, this lead to double taxation, like, the same profit has been taxed twice in two tax authorities on the both side. So there's currently no automatic corresponding adjustment mechanism with foreign tax authorities and RRA, you know. So the disputes may be resolved case by case. It's not an automatic route. That's in brief, Roger. Back to you.
Yeah. Please also take the next slide. I think we would like to know now what are basically the common risk areas. How can companies maybe check their financials where they might have the risks?
Thank you. And this is one of the most essential. These two slides, I would request everybody. This is this is the key crux of the whole matter, what we discussed. What are the common TP risk areas? As Vinny was explaining earlier, lack of TP documentation. See, I already explained what RRA expects to be in a TP documentation. Those needs to be taken care. I'm not going to just repeat in the essence of time, but there is another term which Vinny briefly said was benefit test support. So there is intergroup services being rendered. It could be management services. It could be any services, primarily, especially management services. There are few issues in that, and I want to discuss that. Especially, you see below, we have also said management and technical services. The main thing is TP documentation to support the arm's length nature of services. Then you have to, in the documentation, what you need to document is explain the nature of services rendered and the benefits received. Winnie briefly said there's a benefit test. It's in OECD TP guidelines. It clearly says that service benefit test is 3 steps actually. Prove whether a service has been rendered. Second, an actual benefit has been received. It was not just received because the control party wanted you to receive that. You actually needed that. So first, service rendered. Second, there's a benefit received. And third step is there is an actual, if third party would be willing to pay. It is called willingness to pay test. So the 3 steps, your TP document is not adequate if you have not done a service benefit test where you have proved that their actual service been rendered, your documentation so there is a benefit received, and there is a willingness to pay. If third party would be willing to pay for similar services if they would have received. So that's a benefit test support which you need to document. This is very, very critical. That's why I said this particular what we're discussing is very critical to make sure you align with the documentation expectation. Then documentary evidence that services have been rendered. You have to have at the back, you have to have a file where you have to have all the minutes of meetings, any invoices, any presentations, how actually the service was provided. If they ask, those things can be provided. Then the question comes, what is the basis of charge? Any profit markup and how it is being established. Okay, you say a cost plus X%. Just Vinny gave an example, cost plus 2%, for example. Whether it was a cost plus 10%, how did you arrive at cost plus 2%? Did you actually do a planning study? Did you check what with a benchmarking where the third parties for similar services are actually earning that? So you should actually be looking on those and then establish that, yes, we did a planning study or something. And then based on that, we did a benchmarking analysis. And hence we found that third parties companies are charging X cost plus X markup. And hence we chose that markup as our pricing policy. Then you are following an arm's length. So the most important thing is weak benchmarking analysis. The weak benchmarking analysis, you are using inappropriate comparable, you are taking broader comparable. If you're looking for software development and you are taking management services or some other services which are not customized software development, for example. So it is very essential, often we see as a benchmarking expert, long back, 17, 18 years back when I was started the global benchmarking, the biggest challenge we had in US and others and all was benchmarking. And still today, after 18 years, I still see the same thing. We have inappropriate comparable. They're not actually matching the functions which you're saying. So your benchmark, your comparable company should be similar to what your function is being performed. And there's a expert steps of things which we need to do, which needs to be established in the TP documentation. Before I go into the conducts and contracts, I want to talk about the cost. The most important thing is what allocation key is used. Winnie mentioned that, in her thing, that what allocation key. When you're allocating cost, there are direct cost and indirect cost. How the direct, is it based on actual cost? So now, for example, if you're providing strategic management, CEO, CFO, now CEO and CFO will not fill timesheets, right? Maybe your IT software guy might fill timesheet. So in those cases, you have to have an estimate of time cost estimate that 30% of the cost time he spent on Rwanda, 70% he spent on something else, then actual time cost estimate. That is the allocation key, and then based on that, and then you give other allocation key. Is it revenue? Is it actual time spent? What are the allocation keys based on which you have decided the direct cost and indirect cost? That is very key. One of the key issues which we always find taxpayer often miss is that they often charge pass-through cost. Pass-through cost, of course, like if the person who is providing services gone to a hotel and stayed in a hotel, now that is not a value added. That is a pass-through cost. So that should be charged without a markup. It should be passed on because it was a cost incurred on behalf of related company, but it is a pass-through. Shareholder services, if any entity is providing, say, it's a parent company and there's a shareholder. So any services provided as a shareholder cannot be charged. Because why? Because it is essentially it's for its own benefit. It's not for the related company benefit. For example, a parent company anywhere outside Rwanda is performing shareholder services because as a shareholder he or she needs to provide their services, but it's not in Rwanda's benefit. So why should third party will not pay it? So why should Rwanda entity pay it? So it's not allowed to charge shareholder services. There shouldn't be any duplicate cost. If the cost is already being incurred somewhere, like for example, if there's an HR there in local entities doing recruitment and you have an HR there performing the same function, how can the RR will say, oh, you already have a recruiter here. Why you are having a recruiter there unless the different recruiters are performing different level of functions, then it's fine. But if they're performing same level of function, both are recruiting junior managers, then they will say this is duplicate and they will disallow it. So we have to be very careful in terms of cost, what cost, pass-through cost, shareholder services, duplicate cost, those kind of things. Again, as I said, management and technical services without allocation basis, lack of commercial benefit with the service benefit test, they will disallow those things. And please remember, ladies and gentlemen, management is one of the highest audited across the globe. RRA is not behind. They understand how risky it is. They want, if the taxpayer is actually receiving a benefit, then only they should be paying it. Otherwise, they will disallow it. Failure to apply withholding tax and reverse VAT. If you are obviously, if you're not applying the withholding tax, in the invoices or your VAT, then obviously on cross-border service payment, those will be challenged. Related party loans, the most common after management services are related party loans, often across the globe. And so in Rwanda, whether there is a collateral, whether there is a repayment payment, it cannot go on for, forever. Otherwise, it will be treated as an equity rather than a debt. And then with interest-free loans, whether you are actually, so, interest-free loan has a very, very, very interesting story. One, if you are providing an interest-free loan, RRA will say, who a third party will give anybody loan without interest? Why you're not charging it? So they will do a benchmarking and they'll see for that, what is the interest charged by third party? They will make an adjustment and ask you to pay for that profit taxes and adjustment. So you cannot have an interest-free loan. But there's this funny incident happening. You say Rwanda provided interest-free loan and say Mauritius received the interest-free loan. We have seen recently because as I said, transfer pricing is not one-sided. It's two-sided, right? We have seen in Mauritius side also and many other tax authorities, what they say that they should be happy, right? Interest-free loans means more profit in Mauritius. But no, they also say you should have paid an interest-free. And then they will say this is a deemed interest, which you should have paid as per arm's length, and they will charge a withholding tax on it. So again, you are exposed to double taxation. You are adjusted in Rwanda, for example, and then in Mauritius also, for example, they will say, oh, you should have paid an interest as per arm's length, and then you pay a withholding tax. So we have to make sure that our related party transaction arm's length or intercompany loans are as per third party rates, interest rate. The last which I left, it was in the center, is mismatch between conduct and contracts. Always remember what your contract says, what your legal form and what you're actually doing should be matching. If you say a lot of things and they are not actually matching. So I often say, and when he's here, she'll better uh, is a better person to tell you. But what, from my experience of tax authority dealing, they always have your audited financial statement on one side, they have your contract agreement on second side, and third side you have a TP documentation. Any mismatch, they will go and audit and see if there is everything is right or not. So that is all. That is all we have to say on this. So next slide, please. I see somebody saying that Mauritius withholding tax does not apply. I agree because of the tax agreements and all. Totally agree. But it's just an example, that you may have DTA with certain things, but there are tax authorities across the world who are also, even if they are receiving interest-free loan, they are charging, they are assuming a deemed interest and they are charging a withholding tax on it. It was just for example purpose without getting into the DTA and all details. I hope that answers your question. I saw that pop up. So to avoid TP adjustments and penalties, what are the key recommendations? Strengthen your TP documentation. Prepare TP documentation before filing a income tax return. It is on or before of filing of CIT returns. It has to be. Please understand, transfer pricing is a robust process. It cannot be done in like we say often in our normal language with the colleagues. You can do a corporate tax return maybe in 15 days or 10 days. A TP requires at least 3 months. It's approximately a 3 months exercise. Even if you rush through, then there's high chance of you getting into making weaknesses in the report. We can always rush through and try to do it in 1.5 months, 1 month, but TP is a robust exercise. So always do it in advance. Take your time, prepare documentation in time before the CIT returns is there. Performs robust benefit test analysis. As I said, there is a service rendered and there's a benefit received and there's a willingness to pay test. That needs to be there. Beside that you need to document the services rendered in detail. You also need to have a file where you maintain evidences like emails, reports, timesheets, evidence of decision making. When you're saying there is a head office or strategic management services provided by CEO or group IT head, what is the evidence that decisions being made, some documentation, which should be in your file. If any tax authority asks you, you're always there, always be proactive, demonstrate commercial value being received. When you actually say that without these services, if we would have gone to the market and would have asked third party to provide the same services, this is the benchmarking, this is the return they would have asked us from third party. And hence any third party would be willing to pay for it. That's how you demonstrate, service benefit test. We often see this being lacked across in TP documentation. Third, align TP policy with operational reality. As I said, contract versus your TP documentation. You say that, okay, you have no control, but board meetings reflect actual control. You say risk assumption. You are saying you're assuming risk, but do you have capacity? In OECD TP guidelines and which followed by RRA, they said, first, it's not only about you assuming the risk, but do you have the capacity? For example, in intercompany loan, we do a debt capacity that you can provide loan, but does the recipient has the capacity to pay that loan? So in the debt capacity, we say that what third party, a bank or financial institution will only give you loan as per your capacity. Anything beyond that, that will be treated as an investment in equity, and hence there will be no deduction allowed on those kind of interest being paid for the loan. So we have to have a debt capacity. Similarly for others also, whether you have the capacity. Substance alliance profit, we keep saying that whether your business form is actually, you often see CEO being there and you say, okay, he goes twice a year and then he's there. No, where is he employed? Whether he's tax resident? Is he there? Then only it will be considered his function being performed. So your substance should align with the profit allocation. Review of cross-border tax implication. Always look at it as just we talk about withholding tax, we talk about reverse VAT. In certain cases, DTA, we have to look at the double tax. And I always say I'm a TP person. We have an impact on DTA, but the corporate tax guys help you with the DTA and all those things, revert VAT obligations and those things. You have to make sure that those things are there. The treaty application conditions, whether the DTA gives you reliefs or not, those things needs to be looked into. Maybe in the one country you may get a DTA relief, but other country you may not. So that's in all, Roger, on the key TP recommendations and the risk. I hope that's helpful for the taxpayers.
Yeah, thank you so much for your elaborations. We are running a little bit over time, but I see the numbers are still quite strong on the participants. So
yeah, unfortunately, we started a bit late because of technical issues. So sorry about that, ladies and gentlemen.
So, and I also see, and I will take this question very briefly on the Q&A chat, where you can send us questions. From William, he asked, is it mandatory to submit local TP file in Rwanda while submitting the CIT returns, or submission is only on request? So we had it. So theoretically, or based on the law, it is required. You have to submit it. There is a space for it. It doesn't have the red required documents, but in the law, in the tax procedure law, it is basically mentioned. And yeah, so basically I can maybe ask Musoni, who is raising the hand. I don't know if she wants to say something about this topic. Maybe someone can unmute her. But I know as well that there is like discussions that from ICBAR discussions that, okay, do we really need to submit it or not? And I know these discussions are there, but in the law it's written, you need to submit it. Yeah. I don't know, Kudlamo, can you give her a voice to Musoni?
Yeah, just unmute her. Otwano, can you do that?
Musoni, you are unmuted.
Selena, you have to unclick your mute button and then you can talk to us if you want. I see you have raised a hand.
Okay.
In the meantime, Kutwano, can you go to the next slide, please?
Yeah, so let's move on. So to the next slide, please. So I'm going to ask a couple of questions to RRA. Some of them I keep them short because of time, but we want to basically just hear from Winnie directly some more insights. I think, I don't know if you can talk about the policy decisions or how they came up, but can you maybe tell us why do we have to also consider the domestic transactions in the TP scope? Why is this really relevant?
Thank you, Rogers. Domestic transactions may also carry transfer pricing risks. Let's say, for example, when you talk of special economic zone or preferential regime rationale, they normally have subsidized rates or don't even pay any tax. So when they're transacting, there's a transaction between two related parties, for example, one is in a preferential regime, the other one is paying tax at a normal standard rate, then there would be a risk. They would tend to increase costs where they pay tax at a normal rate and make profits where they are not going to pay any tax. So it's always, given that they are domestic, they also have to respect the arm's length principle. So what is normally done, we adjust. We adjust and say, let's say, for example, they increased their cost in this and led to, or maybe a company not paying a profit because they know the other company is paying tax at a subsidized rate or not paying tax at all. So what is normally done, adjustments are made, and then, but the good thing about domestic transactions, you adjust on both companies. You do adjustment here and do adjustment on the other company, but they also have to respect the arm's length principle and transfer internal transfer mispricing may also occur in local companies. Thank you.
Okay, thank you so much, Winnie. I think that's something that often gets overlooked, and I think it's really important to mention. On the number 2, we have already seen an example. Then maybe, Winnie, you can tell us a little bit more about this deemed dividend. What is it exactly when you allocate the penalties, and what is like the purpose? Because the penalties rise very high on a TP audit if you face challenges. Okay, you're on mute. Maybe you need some time.
Winnie?
Hi, Roger. My name is Lucy. I will take the question. So the deemed dividend usually comes into place when there is a primary adjustment for transfer pricing. So using our previous example that Winnie had demonstrated, when there is a primary adjustment, it is deemed to be a deemed dividend because it is deemed that the related party on the other side has been enjoying benefits they should not have been enjoying. So when there is a primary adjustment, after you account for tax, the remaining balance is treated as a dividend and it is subjected to withholding tax at the appropriate rate. Is it a punishment or a policy design? It is a policy design, but it is meant to discourage transfer mispricing between related entities. Thank you.
Thank you so much. Yeah, sorry for the wording here, but it's good to know that we also have this risk of this deemed dividend. Thank you. Next slide. Yeah, now we have probably the most interesting part, which I really would like to see resolved, hopefully soon, with Ministry of Finance and RRA to make Rwanda more attractive. Winnie, can you tell us how does this 2% management fee cap interact with TP documentation rules? Because we are basically, for CIT purposes, not allowed to have more than 2% of the revenue as management fee, while on the other hand, we have TP rules which actually force us to maybe charge more management fees into the country. So I would like to hear about your thoughts of this topic.
Thank you very much, Roger. So 2%, when related companies are transacting, their allowable cost should not exceed 2% of the cost. But then this 2% is also subject to arm's length principle. It has to respect the arm's length principle. It's not a guarantee that you will benefit 2% when it's not properly documented. So given that there are controlled transactions, documentation is still relevant because this 2% may also be disallowed if it's not properly documented. Thank you.
Okay. Yeah.
Can I ask one question, Roger, to Winnie? Winnie, it was like totally aligned with you on your thought on that, if the service benefit test and all those things are not documented, this will be disallowed by your team, your colleagues. What I want to understand is that if we do a proper benchmark and we see there is actually service rendered, benefit received, and a willingness to pay test is followed. But when we do a third-party benchmark, we say, assume a cost plus X% markup. I'm assuming X as anything, maybe 5, maybe 10, whatever, as per the benchmarking result. Now, if that markup leads to more than 2% of management fee of the Rwandan, then, because if we don't charge on the other side, maybe US or wherever, UK or wherever the related party is in across the world, they will actually charge the taxpayer penalty for not charging as per the arm's length principle of benchmark. But again, if we charge here, we are subject to a 2% management fee. So my question is that if the service fee cost plus markup goes beyond 2%, what should the taxpayer do then?
Thank you. I think those are two separate items. There's a requirement under Article 32 to maintain TP documentation and to document all control transactions and ensure that they are at arm's length. So the first step is you make sure that all the control transactions, so in this case, because you're referring to the 2%, so all the transactions that relate to management fees, to royalty fees, consultancy fees, and related fees, you maintain them, you document them in your TP documentation, and you still benchmark and ensure that they are at arm's length. But then there is Article 29, which is a safe harbor provision, which is not a transfer pricing provision. It is just meant to encourage companies to source for some of these services locally. So they still have to be arm's length, and if it is beyond 2%, you're still supposed to cap. It is different from the arm's length principle. It is a safe harbor principle. Thank you.
Yeah, so basically, if I summarize, maybe we have the two topics are, one is the TP side, so at arm's length, and the other one is corporate income tax side, where you have a cap. Everything beyond 2% is non-deductible for corporate income tax. Yeah, I think for me, as a business person or a financial person, it's a tricky policy choice. I think if anyone has the power to bring this up to the relevant decision makers, it would be nice in the future, now that we have TP enforced, that this cap, this protective cap, is going to be removed in the future. So people can actually, or will actually, charge the right fees into the country without really being disallowed the expense.
And especially, Roger, in terms of royalty also, if third-party rate clearly says that you need to charge an X% of royalty, and actual, I'm talking not, it's when everything is properly documented and everything. If it goes beyond 2%, if they don't charge, they are damned, because the other side they'll have an adjustment and penalty on the other side of the truth. And if they charge, there is a cap. So we'll urge Winnie and the colleagues to look into this, internally, maybe discuss and see if that can help taxpayers to, if they are, it's like, it is very clear that we have to enforce, make sure that there's evidence and everything is there, but they should have a fair share of payment if they do those evidence. But if there's a cap, there will be a double taxation, and that's a big risk. So we would request the team to maybe consider in the future discussions internally, possibly.
Yeah, thank you. So on the point 5, I just want to hear from RRA, because we have a lot of companies in Rwanda that have maybe a parent or a sister or related party which is in Mauritius or UAE, and they qualify based on the TP guidelines and laws in Rwanda as beneficial tax regimes. Now, what is exactly the implication that I need to consider as a taxpayer and the person who is declaring? And do you also have a list of these countries which are basically falling under these beneficial tax regimes?
Thank you for the question. No, we do not have a list of countries that qualify as beneficial tax regimes. However, in the ministerial order for transfer pricing, it defines extensively what qualifies as a beneficial tax regimes. We wouldn't really put it out there that either Mauritius or UAE qualify as beneficial tax regimes, but it will be evaluated on a case-by-case basis, because you may still find companies that operate in countries that have tax rates as high as 30, but where they operate within a preferential tax regime. So within our law, within the ministerial order, that would still qualify as a beneficial tax regime. So it's on a case-by-case basis. I don't think there's going to be a published list of countries, but if you know the tax rate that is paid on the other side, or the other benefits you get, and you check them together with our ministerial order, so you're able to know if that company is actually operating within a beneficial tax regime.
Yeah. Okay, thank you. And I think just there for the rest of the participants, you have to carefully read what are the requirements if you have transactions with a beneficial tax regime, because you will have to put a lot more of documentation on your TP annexures. Thank you. For the next slide, please. Okay. Rajneesh, maybe this is for you briefly. standard markups, why are they dangerous? And when do you or should you engage with an expert on this topic?
So Roger, briefly, standard markups are dangerous. You cannot have, like, in a particular tax year, you see the global trend going on now, Iran war, and how the market reacts versus there are many things going on across the world. Certain years are, like COVID was pretty bad. Now, if you have a cost plus 10% markup in COVID, actually it's not achievable. That year, probably, the companies were earning much, much lower or almost making losses versus in the profitable years, So what we say that industry goes up and down, there's no standard markup. That's why tax authorities like RRA always ask us to do benchmark. What is the return on that particular year, which reflects the actual market condition and based on what third party would have charged, based on what situation they would have. Similar to that, a market rate should be charged between related companies. You cannot have like an on-offensive lower side or upper side, it should be based on what actual market reflects for that financial year. So always do a benchmark, always do a roll forward if there's no functional change. So it is the ideal way of doing it.
Okay, that's great. And I think number two, unless you want to say something, I'm going to skip. We have heard already about
Just briefly
the.
that if you are seeing an LRD structures like limited risk distributor, tax authority is interested, are you taking any risk or not? Always look at the Incoterms, look at whether you are having inventory, whether you're having tangible assets, look at those things. And then, and if you don't understand, take help from us. We'll help you document and all, we'll help you a proper characterization. Often it's not always intentional, but sometimes because lack of understanding also leads to non-compliant structures and often challenged by tax authorities. So please ensure any contract service risk model, whether it's actually a contract risk or full service model, that's an LRD structures. These are always low-hanging fruit for tax authorities. They always want to ensure that your business form meets substance. So this is very, very essential. You need to focus on those low risk models, sales agent, and all those things, and make sure it falls within the arm's length principle.
Yeah. Okay. And then on point three, basically, it says that you need to take local comparables, but they're often not available. So how do you now benchmark this in Rwanda?
This is a challenge, Roger. This is a big challenge, and not only Rwanda. I have faced this many, many years. In last 18 years, in majority, I worked with Deloitte, EY, KPMG across the world, and I always had this issue. And what the right way was, we first try to achieve if we get enough companies from Rwanda, like from 2006-7 when it initially started in a big way. And I was part of the head of the global compliance benchmark of EY. We started the team in 2007, and then I was head of the global benchmark team of Deloitte. We did 150 to 200 benchmark with one team across the world. And that's why I'm saying this, because I have like probably more benchmarking experience than many, many of my colleagues, with like thousands of benchmark being churned out by me and my team globally. What we have seen is that what we try to do is that first we initiate that, okay, we actually went and tried to find out local comparables. In absence of local comparables, should we expand to African region? Or then what is a comparable region? Then we go to EMEA, which we call it as Europe, Middle East, Africa. And if we don't get in EMEA, which is rarely, then we expand to global. So what we say, we always start with a small chunk. We try to see if there's enough Rwandan companies, which all of us know is very difficult. They don't qualify. They don't qualify very standards. Please remember, these benchmarks are not standard benchmark. We have to find independent companies, not companies who have significant related party. That's why majority of the Rwandan companies get knocked out, because majority of them may have good amount of related party transaction. To find independent companies performing services who does not have significant RPTs is always a challenge. We can always expand. If we don't find Rwandan, then we expand to Africa and EMEA market. But again, Vinny and colleagues can tell better, but this is based on what practical issues we have seen.
Okay.
If we demonstrate that we have no comparables and we went to expand it, then I think we are fine.
Okay, that's great to know. Next slide. So I'm going to structure maybe the question a bit different in terms of basically how are UAE Abu Dhabi structures assessed post the 9% UAE CIT introduction. Maybe you can tell me more about, okay, if I have a structure there, which we have seen recently becoming more popular, that people say, okay, I want to basically pay taxes in Abu Dhabi or UAE. It's much more interesting for me than paying taxes here. What would you answer to them?
So Roger, I have a very interesting take on this. I'm a TP expert. I'm a transfer pricing expert. Any corporate tax percentage, I say, okay, maybe corporate tax professional. That's great. If it is low or high, what I intend to say that your structures, whether the business form has substance. Now you want to have a structure in Abu Dhabi, UAE, or wherever in Honolulu. But whether you have people function, as I said, if you really have people function performing those services, you cannot. 2015, I was lucky to be one of the few trainees in Big Four in 2000 BEPS training, and what we called OECD trained us, and they said white coat labs. That's the term they used. And what white coat lab structure is like, CEOs and CFOs traveling by plane, going there for 2 weeks, 3 weeks, and coming back and say that okay, maybe we have a substance. No, whether the people who are sitting, if you have a UAE structure, irrespective of maybe 0% tax in any entity, but if you have people who are their employees, who are providing those services, then I don't think any structure has an issue. The problem we often have is when your business form is there, but substance is not there. Actual people performing services or functions are not there. So if you have a business form, we can help you and tell you what substance you need to add. You intended it. Now it's time for you to add substance. Employ proper people who are performing the functions, who are providing the services from there. Most important, people think that, we can, often taxpayers are confused whether we can travel there and know whether you are tax resident in that country, whether your payroll comes from that. That is essential to evidence. Again, as Vinny said, evidence, documentation to evidence that, okay, there are senior people. Please remember, it is always about the senior people, the control. It's not about junior people. You can't have few admin people sit there and say, okay, the service is provided. You have to have some senior people who's actually, if there's a procurement structure, some serious strategic procurement manager or a senior person who is having the experience and the knowledge and who is doing it from there, sitting there and being an employee of there, then you have substance. So from transfer pricing perspective, if we have people performing function, even if it is a 0% tax, there is no issue. The problem is when you don't have people function there, or when sometimes we think that, okay, we can have a management company and not real people, then it's an issue. Then tax authorities feel that, okay, your functions are performed from Rwanda or maybe whatever jurisdiction. So you don't have actual people. So maybe we'll do an adjustment. So it's more about substance over form rather than the percentage.
Yeah, thank you so much. I think it's basically these jurisdictions are very attractive. They make a lot of sales for their setups. But again, if you do not perform maybe the activities, the controlling activities in these jurisdictions, you run at risk that if RA finds it out, that you are going to be in trouble during a TP audit. Yeah. Okay.
This is exactly what we cover in health check. We identify those risks and tell them what you should do to add substance. That's why I always say, do a small health check at a little cost, understand your risk, and then add substance, and then try to, maybe you are not intentionally doing it, maybe unintentionally, but if tax authority finds it out, they will feel that you did it intentionally. So maybe do a small health check for a little cost and find those errors and add substance to it, fix your structures. That's a health check about.
Exactly, yeah. If you want to maintain it in these countries, maybe you have to move there as the owner and perform the company activities.
Or maybe hire senior people who perform those services from there.
Yeah, exactly.
If the owner doesn't want to move there.
Yeah, and then on point 6, what does BEPS Pillar 2 mean for African multinationals?
This BEPS Pillar 1 and Pillar 2 is it's the song of the day. Everybody thinks what is BEPS Pillar 1, Pillar 2. So what we understand, again, RR is the better person to say, but what we have from our understanding and from the practice, what we see is that, the low hanging fruit in Pillar 1 and Pillar 2 is the routine return for the distributors. So Pillar 2 is actually looking at, giving a routine margin for routine distributors. What it does is that, it helps taxpayers, the Pillar 2, this part, for the burden of, determining every year the benchmarking for this routine kind of companies. But asterisk attached, please, it's all about routine, simple functions, they should get a routine return and they don't need to perform a benchmark. That is what Pillar 2 is achieving. RRA, including all the tax authorities, are looking to help taxpayers with this. But before and when it gets implemented, we will let you know. But right now, that's what OECD is trying to implement by Pillar 2 with this routine distribution return for African multinationals.
Cool. Thank you. Next slide. So here I skipped the first one, but I would like to address it to RRA for the number 2. Winnie, can you tell us what developments should we expect in Rwanda's transfer pricing landscape going forward? Or maybe you can tell us, what are you at RRA working on at the moment? What is like occupying you very much in these days?
You are on mute.
Yeah, I think she's ready.
This is Vincent. I'm with Winnie. I work with Winnie. So to address question number 2, saying what developments should we expect in Rwanda's transfer pricing landscape going forward? Yes, I would say that currently we're trying to revise our transfer pricing guidelines. Of course, in aligning it with the tax procedure law and the income tax, as well as the current developments, international tax developments. So we also want to introduce advanced pricing arrangements, or taxpayer maybe want to come forward to area to maybe kind of have like an agreement with the tax administration for a certain related party transaction before maybe they enter into that transaction. Thank you.
Okay, and Vincent, are you, because I come from Switzerland originally, and we like very much to have like safe harbor rates for like shareholder loans and these kind of topics. Are you planning to also come up with something around these topics, safe harbor? Just for the others, while RRA is preparing for the answer, safe harbor basically says, okay, if I receive a loan from the company as a shareholder, what should be the minimum interest or maximum interest that is allowed to be charged? Yeah, and it gives me as a business person a simple way to then basically comply with the law. I don't know if RA wants to answer this about safe harbor or we skip it. Maybe if we don't get an answer, Rajneesh, you can take point 3, who bears the burden of proof in a TP audit? And how do you challenge tax authorities' comparables?
So the burden of proof is always on taxpayers. As Winnie and her colleagues, everybody said, and it's clear that, we need to have a proper form of documentation. We need to document the related party transactions. It should not be one-sided, it should be two-sided. It should have all the evidencing. If it is service provided, you should have a service benefit test. You should have the allocation keys. You should have all the documents which are required in your TP documentation. So, and then you should also have a TP file where you have evidence, which we just discussed. Save those things. If tax authority asks you, that's as an honest taxpayer, your everything is in order. You provide them. You have nothing to hide. If you don't understand, you can always ask us, and we can help you with those things. And that helps. So burden of proof is on taxpayer. If you cannot prove, tax authority is in the right to challenge and penalize or disallow, and they are within as per the tax law. The question is, how do you challenge RRA? I would not use the word challenge. I would say as one who has been part of global benchmark teams, who has done global benchmarks and led the teams in global benchmarks in Big Four across life. We always look at consistency, and I believe same thing the taxpayer looks, there should be no cherry picking. That's what tax authorities ask us. I have dealt in biggest audit in large revenues across the world with UK, with HMRC and US and ATO and Singapore and South Africa with SARS and others. What we see is that you are not allowed to do cherry picking. There's a process. You run the process. You run the steps. You find independent companies within the threshold who are providing the services or performing buy and sell. And what is the margin there? And there's an interquartile range which you achieve if you're performing a benchmarking and whether you're falling within that. That's how it is. Now, most important, what we find, certainly we find that some companies either through cherry picking or maybe tax authority or maybe whoever might have felt that this is comparable. But often when we go and we see why that company didn't appear in our benchmark, because there were X number of steps we applied for the company to be independent, and they might have fallen because of that. Then we go and politely ask them, hey, this company was rejected because of A, B, C, D. They didn't cross this threshold. Maybe you want to revisit because this is no more independent, even if they seem to be comparable. Second thing, are they really performing the services or functions which we are looking for? If they are performing like 3 services, we don't know what is the revenue source. Is it majority from some other source? Like, for example, in IT services. IT services, if you are actually providing customized software development services, then it's a cost plus markup. But if the comparable has a product, now, if you have a product, means you continuously invest in that and you buy and resell. And when you're reselling the software, your model is different. It's a resell plus. So if an IT services company has a product as an intangible, then it's no more comparable for IT consulting or IT services, because IT services, for each client, they provide services and they charge a cost plus markup. Versus a company who is also doing reselling the software, I remember before 17 years, I was in software and Oracle and all, and I gave one of the client 97% discount, and I could still make 330,000 US dollar. I got the best deal award. So, the resale model is very different because your cost has been incurred once. You can charge whatever price, and you are actually looking at margin versus cost plus markup. So often this small understanding, what is the source of revenue? Is it because of the comparability of service which you're looking for the function, or are you also earning revenue from another sources? So often we go and politely put that and say, hey, these are the reason why this company was rejected. We provide them an answer. And more often than not, I have been in part of big audit case, which I can't tell you, but I was able to successfully evidence them. And then obviously the tax authority, when they understand, they say, okay, this is fine. We can go ahead with this. All they want is honest in evidencing from taxpayers that you have done a proper benchmarking, your comparables exactly matching. And Vinny also said that we often reject if your function is not exactly matching with what you are saying you are providing services with.
Yeah, thank you so much for this answer. I think that also kind of answered point 4.
Yes.
And I skipped the last one about the 2% cap. So I would like to maybe go to the slides after next steps. Thank you so much. Rajesh, you can maybe comment on that.
Okay, so briefly, since we are almost on time and crossed the time now because we started late because of the issues we had. So I'll go briefly, but this is very key. This is the conclusion. We have to identify the most material and important intergroup transaction. We have to identify as per the local laws, as per the thresholds. Is it, we have to see what are the intergroup transactions. First, identify them, then cover them in your TP talk. Be proactive. Verify your TP policies. As I said, by validating whether it's in arm's length or you need to correct their application. Maybe it was not intentional. You had no idea. Perform TP health check. If it is not whatever it was done in past, you can perform a planning study. I always say any new transactions, when you're starting, that's the right way to do a TP planning. This is the function performed. This is the asset employed. This is the risk assumed. Based on this, what a third party would have charged. We evidence that if RRA asks you, say that, hey, we did this TP planning, we corrected ourselves. We found that, okay, this is the planning, this is what third party charges, and hence we have updated. And next year you can do roll forward if the function doesn't change. That can also act as a local file. Planning is where we recommend what arm's length margin you use. Local file is compliance, where you test. You see whether already it has happened. It's a postmortem, whether the transaction is falling within that, in the arm's length, whether it's market or not. Again, health check. Please make sure you know if that you will never know, because every country is doing differently. Transfer pricing is two-sided. You have impacts on both sides. Health checks helps you to realize, okay, maybe you have business form versus substance issue. Maybe you need to have senior people there. Maybe here. That helps you go to the crux and properly plan. Once your business form meets your substance, everything is easy for you. You have a happy and nice time with tax authorities. You can say, hey, I have nothing to hide. My documents are evidence, everything is there. Always design a TP strategy. Please remember you have to manage risk. Risk is one of the most important things. How to ensure a robust and compliance TP framework in place. Once you're done, my finance colleagues, with CEOs, friends, you'll always have a much peaceful life. You are nothing to hide. You have taken care of the drugs, and your business form is aligned with the substance. Taxpayers happy, tax authorities are happy. But if you just go at the last moment and try to align it, you'll always get into the controversy side, if you remember what I said. What is critical to maintain contemporaneous TP documentation is that, please remember, is the first line of defense. When any tax authorities across the world, not necessarily Rwanda, you have the other side also, they also look at it. That's why I asked Vinny the question. If you have other side, they should talk to each other, and you should document two-sided and make sure that, based on the function, perform, asset employed, and risk assumed, they are earning this markup or margin. Always monitor your evolving domestic regulations every time. Tax authorities across the world, as I said, including Rwanda and RRA, they are being trained by ATF, they're trained by OECD, they're having many meetings, there's sharing of informations. So always see what is the latest TP regulations, domestic regulations, so that you are in there. Obviously, it's like Enrique and Vendra, me and my team, like we have worked. Cabrini, my colleague, she has led the African audit, the largest client, biggest giant, Deloitte and others. Previously, she led the whole controversy. So we work with tax authorities, helping and solving those issues in the major jurisdiction. I have worked for similarly. I have 18 years of experience with EY, Deloitte, and KPMG in Singapore, in London, in Kuala Lumpur, India, US, and various countries, and across South Africa, Rwanda, and all the Eastern African countries. So many of us. I'm working with a lot of software development clients right now with Roger. We're assisting them, helping them solve the issues, and many other issues, automobiles, airlines, and other industries also in different perspectives. So we're happy to help you. Either you're small or big, based on that, we can help you start with the health checks, and we can always help you if you need anything. Again, we, as part of Big Four, we had to charge for everything as part of being a small firm. We only charge very limited, and we always go and provide the extra add-on help if it is required for helping in operational. We don't charge. We always try to understand what your situation is. That's all, Roger.
Yeah, thank you so
But
much.
Roger, before I conclude, I wanted to say 3 points.
Sure.
First of all, I wanted to thank RRA to be, it's wonderful. It shows the commitment that they are a forward-looking and well-governed tax jurisdiction in the region. And today's discussion reflects the continued commitment to transparency, clarity. Otherwise, why would they participate? They're here to talk with us, to help you understand, and they want to have engagement with the international business community. So thank you from the RRA colleagues for really coming and helping us with the answers. Primarily, we'll, we will say 3 points, please remember. Rwanda has established a clear and structured TP framework. It's grounded in its domestic law and aligned with OECD TP guidelines. So it says clearly refer for its reference purposes. Second, while the systems continues to evolve, we also asked Vinny and colleagues to look into certain things. The expectation around compliance already very well defined by RRA. In particularly the emphasis on contemporaneous TP documentation, transparent pricing, transparency, and alignment with arm's length principle should not be underestimated. And third, Rwanda approach reflects a broader global trend. Transfer pricing is increasingly about demonstrating consistency between what companies do operationally and how profits are allocated. So for multinational groups or any related companies, the message is very clear from RRA. Rwanda should be approached with more proactive and well-prepared TP strategy, supported by robust documentation and a clear understanding of local requirements. Finally, sessions like today, are a reminder of value of open dialogue between taxpayers and tax authorities. its engagement, clarity, preparations are key to managing TP effectively in any jurisdiction. With that, I will like to thank my colleagues from RRA and hand it back to you, Roger.
Yeah, thank you so much, Rajneesh. So similar to you, I'm very happy that RRA could participate and share their insights. I feel free if you also want to say something, Winnie. But thank you, Rajneesh and Regan van Roy. My experience working with them has been very good, and I can fully recommend their service delivery. As he said already, they're distributed across different jurisdictions. They have short ways of communicating, so it's easy for me if I have a client in Europe and Rwanda. We can coordinate. Sometimes the Rwandan thresholds trigger a requirement first, but of course, like we mentioned, it's always two-sided. So that sometimes then also triggers some work on the European side or in anywhere else in the world. And there is Regan van Roy is very strong in this because they have the team distributed with the experience and makes it simple to guide companies who are new to this topic and they might not have a TP expert in-house. And you will be sleeping much better at night if you know that you're doing these things according to the requirements of RRA. And yeah, of course, if you have any questions, you will have the contacts in the presentation that we're going to share. And feel free to reach out as well to us if you have any questions about Regan van Roy or how we usually operate this with our clients to make sure we are safe and we don't have bad conversations with RA or difficult conversations with RA. That is our main objective. So thank you, everyone. And thank you for your patience.
And sorry if you missed any questions because we already moved ahead of time. So apologies if you missed any questions. You can always pass on and we can try to pass it on to tax authorities. But thank you very much for your time. I really enjoyed talking to all of you. And thank you, RRA. Thank you, Winnie and team.
Yes, thank you, everyone. And
Have
have a
a good day. Cheers.
Take
Bye.
care.